Good afternoon and welcome to Cannon Trading in Beverly Hills. This is Steve Nimerov, and today I wanted to share with you one of my favorite trend reversal techniques. It's called Bullish or Bearish price divergence. First, I want to make sure that you realize trading commodity futures and options involves substantial risk of loss. These are risky markets and only risk capital should be used. Past performance is not necessarily indicative of future results. The two overbought, oversold indicators that I like to use in tandem, one for divergence, the relative strength index, otherwise known as the RSI, and the other technical overbought, oversold indicator is called a stochastic. Because I use daily, weekly, and monthly charts, I prefer a slow stochastic. For somebody who's using 5, 10, 15-minute charts as a scalper or is a day trader, you might want to use a fast stochastic because you're going to get a lot more signals throughout the day, and since you're not looking for trending moves, you're just looking for short-term day trades, it works better in my estimation. Nothing is 100%, as we all know. If you've been trading for any length of time, you've realized that, and just buying a market because it's approaching what is considered oversold on the scale, which usually runs between 20 on the downside, which is the oversold area, or 80 on the upside, which is considered a move that's extended to the upside. Many times I've seen a market, especially large world markets, get overbought or oversold based on that idea and keep going. So that's why I will use a stochastic to help me confirm what I see as a signal indicating a turn in the market, whether it's a trend change or a corrective move within a trend. So here is an example of a cocoa chart. This is I'm using for the purpose of visuals, I'm using a candlestick chart, although I usually use a bar chart, a high-low close chart. And you can see here where cocoa had a good run. Looks like we had one leg, two legs, three legs, or 1, 2, 3, 4, 5, which an Elliott wave aficionado might consider a 5-wave move. At the same time, as the market was making new high after new high after new high, you can see here where the relative strength index was not following suit. It made its high on the first move up here, the top of the first leg, and then we corrected. The market went up and made another new high, and you can see here where the relative strength index didn't. And then it made its final new high at the end of the completion of its wave count, and the RSI again made a new low high. So at the same time, when we were making that third lower high, you had a crossing down of the stochastic, which for me it confirmed that the market had run out of momentum and it was ready for an extended move down, which you can now see actually occurred. This is what's called bearish price divergence. The next market we'll be looking at is the February hogs, and for the February hogs, it's bullish price divergence. That's where the prices are making new lows, and yet the RSI isn't following suit like it normally does. Normally, the overbought, oversold indicators will follow in lockstep with the price. As prices make new lows, the indicators make new lows. So in this case, you can see where we had an extended move down. The RSI actually got down to 8. So this is what I meant. Anybody who thought you could, we're at 20, we could buy it because it's too oversold, had a rude awakening and probably got stopped out. Now, we had a little bounce here, and you can see the stochastics actually were starting to give a little bit of a signal that the market was not only running out of momentum, but was ready for a turn. We went down, made a new low by quite a bit, and notice here that the RSI not only didn't get anywhere near the previous low, but it actually started to kick up. And the next week and next day we reversed, and we are still rallying off of this signal. So that is an instance of bullish price divergence. So in order to gain confidence in this combination, or using this as a tandem, I would encourage you to look back over charts, look at how many times this has occurred and what followed with price action in order to build your confidence, and perhaps use this as part of your toolbox. Again, every technical trader, every pattern recognition trader should have a toolbox with various tools in there. There's so many indicators, however. You want to kind of try to find your niche, find a few that work for you, and stay with those. Otherwise, you know, with thousands of indicators out there and techniques, you can get paralysis of analysis, in my opinion. So this is Steve Nimerov again at Cannon Trading in Beverly Hills, wishing you good trading, and thank you for viewing this short video.